The bad luck scenario. Perhaps the most prevalent worry among clients in the run-up phase prior to retirement is what some call the bad luck scenario. That is, what will retirement look like if the stock market, and we're using the S&P 500 for this purpose, declines by 25% or more like it did in 2008 and 3 other times in the past. Almost everyone has a family member, friend, or colleague whose framework of retirement was changed in some ways by substantial market pullbacks. Many times, retirement dates have been set, and the randomness of market returns cannot be predicted. So what should investors do? In times of anxiety or uncertainty, it is useful to remember your why of investing. In other words, why are you willing to take risk in the first place? Everyone has somewhat different specific goals, but the underlying why that each of us have in common is to offset ever-rising living costs. Let's take a look at actual inflation rates to better illustrate. Assume that you were born in 1960. The annual inflation rate from 1960 through 2014 was 4.1% per year. Now let's use the same time frame and review the real after-inflation returns for the Standard & Poor's 500 index. This is 5.6% per year, again, after inflation. Finally, let's review the real returns for 1-month U.S. Treasury bills for the 1960 through 2014 time period. Treasury bills provided a 0.9% per year return after inflation. What these historic returns tell us is that it is very difficult to achieve reasonable above-inflation returns without long-term exposure to stocks. Inflation is public enemy number one for retirees and those preparing for retirement. Remember, essentially everything you buy costs more every year, not just the years the stock market moves higher. We should also remember the difference between random price movements in the market, volatility or variability, and actual market losses. The latter refers to the permanent loss of capital. Unless you sold your investments in 2008 and did not return to the stock market, what is commonly referred to as losses were not losses at all. It is also worth noting that intra-year declines in the Standard & Poor's 500 average 14%, yet the annual returns for the S&P 500 are positive in about 70% of the calendar years. The bad luck scenario really represents 2 separate fears. First, the fear of outliving your financial resources. Life expectancies have risen sharply over the last couple of decades. Longevity isn't a risk per se, as some would argue, but rather an unknown variable. The second fear is that inflation will erode the value of your financial resources such that your lifestyle is impacted. These fears are real, and the answer is to look back at actual market history in order to plan your future. Here at J.E. Wilson Advisors, we specialize in the art of financial science. Ready for a real conversation?